Welcome to the Mayar Capital Annual General Meeting. For those of you I've not yet met, my name is Lee Overall Gibbons, and I'm the Head of Sales and Client Relations at Mayar. More specifically today, we're here to discuss the Annual General Meeting, and we're going to talk about the Mayar Responsible Global Equity Fund. We're going to do this over 3 sections. The first section is looking at the fund and the bench. The second section is looking at US volatility and how we're navigating that. And the third section is we're looking at opportunities, in particular Europe. Now we anticipate we'll do this over 30 minutes and it will be followed with a question and answers session. I would like to thank you so much for the questions that you've put forward so far. I'll be delighted to ask our guests to answer those questions. Now, I have 2 very special guests to talk to me about the fund, and that is Aziz Al-Nain, who is the Managing Director and Portfolio Manager of the Mayar Responsible Global Equity Fund, and Aubrey Brocklebank, who is a partner. He's the Head of Investment Research and a Deputy Portfolio Manager at Mayar. So without any further ado, let me hand over to Aziz and Aubrey for the presentation.
Thank you, Lee. We always like to start by talking about the performance history. And as you know, you can see the history going back all the way to 2011 since inception. And things were going very well up until probably 2021. And then I think we talked about how 2022 and 2023 and 2024 were particularly disappointing. But luckily, this year, 2025, is starting to look up. And some of the forces that have caused the underperformance in 2023 and 2024 are now behind us. But we'll also talk later why we think this has just started and there is more for these forces to run, and why we're very optimistic about this year and the next few years to come. Just a quick look at what our portfolio looks like today. Aubrey and I will get into more details a bit later. But our top 10 holdings, which you probably have seen in the latest fact sheet, you'll see kind of a few things from that and applies just as equally to the rest of the portfolio. I'd highlight that we own fewer US names than we have in the past. But more importantly, our portfolio tilts very conservatively. Now that has cost us some underperformance, especially in the second half of 2024. But we have and continue to believe that conservatism is the right position to have in this market environment. We think it's served us well over time. It's serving us very well this year. It did very well for us in the market turmoil in April. And because we expect more of that, we expect that it will continue to serve us well. And just looking at the asset allocation, we've talked about this in the past. Our preferred measure is to look at asset allocation by revenue. This is how we look at the portfolio. This is how we think about investing. And it basically is the economic way of looking at our risk exposure. Where do the businesses that we own, where do they get their revenues? Where are they economically exposed? On the right, you'll see the traditional way that our industry looks at portfolio allocation. We report this because we want you to see the difference. You'll see that our exposure to US listed companies is at an all-time low. It's also about 1/3 of the exposure that's in the index. So we're really positioned in a way that fits the views that we've been talking about for a while. And then, like I said earlier, has served us well this year. Let's look at the past 12 months and maybe dig a bit deeper into the sources of performance, what contributed to gains and what contributed to losses. You'll see that Unilever, Richemont, Alphabet, Alstom, and Bright Horizons have been major contributors to our performance over the past 12 months. And we had 5 detractors. The biggest two, Vistry and Vestas, have been very disappointing, and a lot of that actually happened in Q4 of 2024. We think this is a temporary drawdown, and we think that they will recover. They've, to some degree, have already recovered from what we think are short-term issues. But Samsung, UPS, and Brenntag have also been a drag over the past 12 months. And we might, I think some of the questions that we got, we'll address that, but please feel free to also ask any questions throughout the session. But this is the thing I want to focus on the most. The current portfolio that we own and the reason for our optimism. This is one of the most attractive portfolios that we have ever owned in the history of Mayar. You will see that over time, the attractiveness of what's in the portfolio, and we'll look a bit at what is outside the portfolio in terms of attractiveness, but what's in the portfolio today, you'll see that red line showing you where we are in terms of the expected or estimated upside from our portfolio over the next 3 years. And you'll see there are very few periods over the past several years where the portfolio of the businesses that we own has been as attractive as the one we own today. And this is in spite of what we think is a very conservative tilt in the portfolio. So we think we are tilted very conservatively, protecting our downside in this volatile environment. But at the same time, we own attractive positions where we have a high degree of confidence that they are both undervalued, but also present us with attractive, high quality growth over the next several years. Now, I want to hand it over to Aubrey in a second, but to dig into some details. But I'll give you a glimpse of a basket of names that constitute our bench or our wish list. And I put the title of this slide, Ready, Set, Wait. And the reason I put it that way is the businesses in here, and we've hid the names for competitive reasons, of course. But the businesses that are here are extremely attractive, high quality businesses that we understand very well and that we are ready to buy as soon as they hit a level that we think gives us a margin of safety below our intrinsic value. And you'll see kind of in this chart, the dots show you the midpoint of what we think they're fairly valued, and the green bar shows you the range. And you'll see that many of them are already actually starting to look very attractive. And in April, we actually started to buy some of the names that were on this list, but many of them are not there yet. But you'll see that we only really need a 20% drawdown in some of these names for them to be attractive buy targets for us. So we're ready, we've done the homework, we're ready to take action, we're prepared, and we always, we've talked about this in the past, we like to be in this position. We love to be in this position. We have to, in order for this to work, to be able to take advantage of opportunities in market turmoil, you have to do your homework before. You have to know exactly what is it that you want to buy, and you also have to know how much you want to buy, how much you want to pay for it. What is the price that you find it attractive? And we always do the homework before. I'm going to hand it over to Aubrey now to talk about some specifics.
Thank you, Aziz. So one stock we're always asked about is Microsoft. And it's because, as those of you who have followed us for quite a while will know, this is a stock we used to own for a very, very long period of time. Because it's one of the best stocks in the world. Well, it's one of the best businesses in the world. It really is fantastic. I don't think I actually need to go into too many of the details because we all know this. We've talked about it in the past. But what I want to try and explain to people is why don't we own it now? And at what sort of valuation might we be interested? This is one stock that we're not really worried about, revealing rough price targets because, if you front run us on it, it's really not going to make a difference.
Unless your name is Warren Buffett, but I've heard he's out of a job, so that risk is out the window.
Yeah, I saw open to work on his LinkedIn profile. Do you think we can afford him?
I don't know. It's a bit
next year. Anyway, sorry. So look, when we think about it, we essentially try and break down the drivers into the 4 key drivers. That is revenue growth, margin, return on capital, and multiple. And I'm going to just quickly talk you through some of them to see roughly what sort of things would be reasonable over the next 10 years. So first of all, let's think about revenue growth. You've got a chart there that shows, over the last 25 years, the maximum it's ever grown is about 16% in any 1 year. And they've actually only done that 3 times. So that's one good way of saying, okay, let's put that as our max. Another thing, and we can look at sort of averages there, but one other way we like to do this is to try and do it a little bit more systematically. So let's take global GDP. We think that might grow at, let's say, 3%. So that's going to take you from 100 trillion to 134 trillion. Now, global IT spend currently is about 5 trillion. That's 5% of global GDP. Now, if that goes from, let's say, 5% to 7%, and we could see that happening, it would be a massive move, but we could see that happening because, IT is delivering so much more for us with AI and everything else. But that's still a massive increase. 40% increase in share is huge. And then if we go, okay, well, look, Microsoft has 250 billion of revenues. So let's say they go from 4% share of total IT spend to, I think I picked 6.5%. Those are pretty big numbers. Well, that actually gets us to about 10.5% growth, for 10 years. And that is huge. If we sort of went really bullish, I said, okay, let's say GDP growth is going to be 5%. Let's say IT spend becomes 9% of global GDP, which I think, it could happen. Microsoft goes to 8%. Then you get 16.5% revenue growth, which is the top there. So we know that is absolutely the top range. That is absolutely the top of our growth. And then, lower end, using the same methodology, cross-checked with history, we get to about 6%. Now, margins, again, you can look at historic margins, and we've got our sort of estimates in there because we can look at different businesses, other software businesses, and Microsoft is one of the best businesses in the world. Definitely can probably achieve a 40% margin, but could it achieve 45%? Maybe at the top range. I know that's roughly where it is now, but there are so few businesses in the world that actually achieve that margin for that long period of time. That's something that we don't necessarily want to bank on. But let's go to our base case. So, we've said revenue is going to grow at 10%. That means 10 years from now, the 250 billion of revenue is going to go to 660. At a 40% margin, that means they're going to be making 263. 263 billion, quarter of a trillion billion in profit 10 years from now. This is still obscene numbers. But then here's one of the problems. Return on capital. Now, that should be around 30%, I reckon, because that's what most great businesses do. Now, Microsoft, is also, let's face it, not as great a business, as it used to be.
Yeah.
And that is because they're spending 80 billion now. This year, they are spending 80 billion on CapEx. That is an increase of about 30% of their 20 to 30% of their whole capital base. I mean, that is just absolutely massive. This has to dampen returns. But having that 30% return on capital, what that is going to mean is that your invested capital of 291 million at the moment is going to have to expand to 878. Now, we can work that out really simply by just going, okay, if you have 263 million of EBIT, divide by 30% return on capital, and that gives you the capital they need. What this means is that tells us exactly how much cash flow they're going to have to spend. And I could carry on going through this, and I won't. The long and the short of it is, if we put this on a multiple of 18, that is, which is, as you can see there, actually pretty high, for compared to average. That gives us about 30% downside for Microsoft. At the bear case, we're actually looking at something like 60% downside. Now, we don't think that's going to happen, but this is what bear cases are for, right? In order for us to get upside that is meaningful, we really do have to go to the top of our range, to the numbers that we were just saying are unrealistic. And as much as I want to own Microsoft, I really do, there are only two ways we can own Microsoft. One is by fudging our numbers upwards, and the other is by waiting and being patient and letting the price come to us. And that's just what we're going to have to do, because when you see people fudging their numbers upwards, that is just how you get caught at the top of the cycle, and then really sort of suffer permanent losses to capital because so let's so I think that covers why we have avoided Microsoft so far. But let's talk about some opportunities now. Because as Aziz has mentioned, Europe is a prime position to capitalize on what's going on in America. Now, granted, this will not be a short-term thing. If America goes into recession, the world catches a cold. We all know that. But at the same time, Europe is in a very, very good position to take advantage of, all this volatility that we're seeing the current administration get up to. And it's not just that, it's also, if you look at the fundamentals of this, the setup, it's almost as if it's been primed for the last 10 years for this to happen. So now we all know that Europe has massively underperformed, and you can see that in the P ratio and in the stock price chart. And it's really since 2020, you've just seen this massive divergence, where US equities, the valuations are up here, and Europe, is down here. And yes, you could say it's all tech, but it is not. It is regular companies that usually would trade on 15 times earnings now trading on 20. So it's not just that. But what has also happened is the dollar has fallen, and a lot of people are saying talking about will US lose its reserve currency status. No, we're not talking about anything that dramatic. But what we are talking about is an incremental shift that doesn't actually have to hurt America by that much to have an amazingly positive impact on Europe. America's bond market is so much bigger than Europe's that if you have a 2% shift from there to Europe, it has a massive impact on the European bond market and therefore flowing into equities. And if we look at the next page, I think we can see why the fundamentals are really in line. So, if we look at the debt to GDP, America is at all-time highs, whereas Europe is very much average. Europe is also average with very low rates. Europe's rates are like 2%. America are about 4%. And hopefully it doesn't get higher, but with wild things happening there, who knows? What this means is Europe has got a lot of firepower. Germany in particular. Germany and Merz, we know, who has just lifted the debt brake. So what that means is that Germany, whose debt to GDP is about 60, they have so much firepower that they can invest in the rearmament and the reindustrialization that Europe needs. Europe has needed this for a very, very long time. One of the charts we didn't publish there is capital additions to Europe and America. How much capex Europe has been spending compared to America. And again, America has been spending a huge amount, whereas Europe has actually been taking capital out. And as we know from capital cycle investing, that's actually a great time to invest. When capital has been taken out, that means markets get tight, prices get better. And when you do then get the capex, it can lead to really positive growth. So Europe has that ability. Investors, because they're getting scared and are looking for other places to deploy money, are looking to diversify, because even if you think America is still great, you have to accept there are now so many more risks that you just have to be thinking, okay, how am I going to diversify? Well, Europe is now giving you the capacity, and it's giving you the opportunity in order to do that. But it's not just that. The performance of Europe is actually not as bad as people think. People have written Europe off for a long time because they've said, no, but look at GDP growth versus America. Well, actually, look at Europe and US as a percentage of world GDP and adjust for currency. Because we saw that currency chart where basically the US dollar has just ripped. And we're talking about many states in America being richer than the United Kingdom or Germany. Well, that only is true because you're factoring in the strength of the US dollar. Once you adjust for that, actually, Europe hasn't done that badly. And one of the things I found staggering was looking at labour force participation rate, where Europe has now actually exceeded America.
Yeah, that number surprised me.
Sure. Yeah, because we've all just assumed Europe is, is an unproductive, forgotten bywater. That's certainly the story that was told when everyone was talking about US exceptionalism. But actually things seem to be changing. And if that is the case, then the effect is going to be huge. And if we go to the next slide, we can actually then talk about one company in particular where we think that is going to have a really, really pronounced effect. So Alstom, they make trains. And we like that because I was a fan of Thomas the Tank Engine as a little kid. And and now every time I get on the tube, I see Alstom written on the bottom, and it makes me smile. Simple things. But they are one of the leading companies. They've got about 30% market share, and it's really them and Siemens who really own this whole market. Now, half their revenue comes from selling trains, but they also do the signalling, the systems, the maintenance. So there's a lot more to it than just making trains. And perhaps if we sort of go to the next slide, we can see really where the bull case comes in. So the bull case actually comes in because whilst services actually only represent 25%, it's actually 2/3 of profit. Now this is something that we saw with Vestas, and we've seen with plenty of other companies where you sell this product at a relatively low margin, but high capital value, and then you get a bond-like return in the servicing because you've signed 20-year deals where every year you are then making very profitable returns. And the thing is, it's very difficult to compete because it's one way you need to have the service density. It's one way you need to have the staff there on the ground. So we think that's going to be very strong. But why is this Germany lifting their debt brake transformational? Well, previously management were guiding for margins of between 8 and 10%. Now, if they achieve those margins of 4%, that means their EBIT goes from 500 to 1.5 billion. And that's just if they get the bottom of their range margins. And if we then put that on a 14 times multiple, we get 50% upside. Now that's very, very nice. But what happens if we get to 10%? Which you sort of think, okay, if all of a sudden Europe is reindustrializing, refreshing its train network, which we know it needs to, it's borrowing the money in order that it can do this alongside everything else, 10% actually might be too low a number, but let's not dream too much. If we get 6% revenue growth, 10% margin, and then let's trade on a 16 times multiple, we'll get 151% upside. And this is the sort of effect that we could see on a lot of these European companies, going from sort of really good upside to incredible upside. And that's why we're so excited, especially because valuations today, when you're trading at 12x EBIT, actually the downside is very limited, which goes back to your point earlier, that we have great opportunity, but actually with quite limited downside.
Yeah. Right. So I guess to summarize where we are right now is we're past a lot of the forces that have hurt us in 2023, 2024. We're already starting to see that our conviction and sticking to our knitting is starting to pay off. Yes, 23 and 24 were painful, but this year is working exactly like we hoped and said it eventually would. We think this is the beginning of this type of environment where the fund and our strategy will shine. We expect more volatility, and I'm sure there'll be questions about that, but we also are ready to take advantage of that volatility. So volatility is good for us. Not only does it historically work well with our strategy in terms of having that downside protection help us in terms of returns, but it'll give us the opportunity to buy all the names that we want to buy. There's great businesses that are just a little bit too expensive for our taste, but we've got the names ready, we've got the prices ready, we know exactly what to do, we've got the cash, we're just ready to go. And it's just a matter of time with this type of environment that we'll get the opportunity to take advantage of these opportunities. So I'm very excited about 2025. I'm very excited about the next 3 years. And as I showed you earlier, I think this is one of the best times for us to own our portfolio. And with that, I guess I'll hand it back to Lee, who is going to go to Q&A.
Absolutely. Well, thank you very much, Aziz and Aubrey, for that presentation. And thank you to everyone who has been on the call so far and who has posed questions. I will put this quick reminder out there that if you have a burning question following that presentation, please put it through. And I'll be delighted to ask the guests your burning questions. As it stands, we've had a whole host of questions come through. So it's my opportunity to put them on the spot with your questions right now. So what we've basically done to help is we've compartmentalized each of the questions into different sections. So the first section is very much based upon risk management and also currency strategy. So I've got a few questions here, gents, for you. So the first question is, many investors are talking about fleeing to gold, US dollar, fixed income, or even Bitcoin as a safe haven. So would you consider that to be sensible? And if so, are you buying safe assets?
Well, I guess the definition of safe assets is always a tricky one, isn't it? Because the definition of safety itself is dependent on the time and what is it that you solve for. I mean, classically, cash is king, but the truth is cash is king only in the short term because it loses value over time because of inflation.
After the inflation we've just seen in the last 3 years, 30%, 40%? That's
No, absolutely. And some of the options that I think came in the questions, like gold, for example. Well, we've seen gold peak in the early 80s and then go nowhere basically until...
It was, 550 in 1980. Then dropped to, I think the low point was 250 when Gordon Brown sold it in 98 or 97. Gordon Brown sold all the UK gold reserves in...
Yeah, he was a great trader.
And then sort of finally 2007, it got back to the previous peak.
And then it skyrocketed around 2011, 2012. I remember when we launched the Mayar fund, and then dropped again and went nowhere for the longest time and just came back. So there's a lot of volatility. And the problem with owning gold is, for one, it just does nothing. It's just sitting there. It's not giving you a dividend. It's not giving you any cash return. So you really have to time it in order to make any money. And the truth is, over long periods of time, yes, it's kept with inflation, but keeping up with inflation is really a disappointing outcome. I mean, there are many more things that have done better than inflation over time, and we can. I mean, you can own, I guess, treasuries, but we've seen the past month that maybe the notion of that being a safe haven is in question. We will see. I think with debt levels where they are, there's a legitimate question as to whether the inflation that could come in the future is compensated by the rate that you're getting paid today. Now there are inflation adjusted bonds that the US issues, the UK also issues. They're probably a good thing to own in your portfolio. I mean, I own some in my personal portfolio. They're good to have. It's always nice to have something on the side. Again, it's not going to make you a killing, but if markets drop 20-30%, you can sell them or at the very least, if you need cash, you don't have to sell your equities to buy them. So I think the downside with equities is that it's volatile. So over short periods of time, they can be a risky option. Over long periods of time, my view, and Aubrey, maybe you'll add to it. I know we agree in principle on it, but over long periods of time, if you own great businesses and you're diversified across industries and you're diversified across geographies, you're probably going to do fine. So I think it's a combination of something that protects you in the short term so that you can handle the volatility that's going to come from owning equities. Is probably the right combination. I mean, the benefit of owning good businesses or great businesses is they tend to have pricing power over time, not in any month or year, but over time they'll be able to increase prices with inflation, and eventually you'll recoup. You'll have that kind of inherent inflation protection. So as long as you are not forced to sell when they're down 20-30%, then you're good to go, I think, over time, which is why a cash cushion invested in something that's inflation protected is probably the right combination. I don't know if you've got anything to add there.
Yeah, no, I mean, look, as you say, I agree with you that in the long run, a great quality business, a portfolio of great quality businesses diversified is probably the safest place to be if you have a long-term time horizon. Now, if you have a short-term horizon, if you're thinking about what do I do with the money that I'm going to pay for school fees, well, yeah, then that's what you want inflation-linked bonds for. Your school fees go in there, that money, and then your savings go in great businesses, because ultimately, as you say, a great business is going to be earning more money 10 years from now than it is today. Yeah. And yeah, so I mean, I would say there is one. I wouldn't really describe it as another asset class. Property is still equity, but London property could be. I was reading, I think, in the FT that they said this could be one of the safe havens that people flee to, because, well, actually, for reasons we've discussed when talking about Helical or British Land, which we own, these are places where actually there is a lot of security in the income. It's a very tight market, and when people want bricks and mortar, and they want something that is more physical. I could see London property, but part of the question, what are we doing about it? Well, we have exposure to things like this.
Well, I think one of the issues with real estate is it's harder to diversify for the average individual. But yes, you're absolutely right. If you were a billionaire and you could own the best building in the top 10 cities in the world, you'll probably be fine.
Yes.
But yes, you're absolutely right. And owning a REIT is probably close to that, but not quite.
But you have the volatility.
We've got the volatility, and you've got people who run REITs tend to get paid very well. So there's a bit of friction that's coming out from that. But yeah, I think you're absolutely right.
Better than fund managers.
Yeah, it seems so.
Thank you for that insight, gentlemen. I'm going to plough on because we've got a fair few questions coming through. So thank you again, audience. So on to the next question. Considering the current geopolitical climate and potential US dollar instability, what is Mayar's strategy to hedge against foreign exchange risks?
Well, I think if you knew exactly which currency is going to do well over time, which is what you would need to decide on if you were to hedge to something, you'd just buy that currency. That's always been my view. I've got no special insights as to what currency is going to do well over the next 1, 3, 5, or 10 years for that matter. Which is why, back to what we were saying earlier, we've always taken the view that you want to be diversified across major currencies. I think for us, if you saw, this is another reason why we like to think about diversification by sources of revenue as opposed to by country of listing. Because we want to be diversified as to where, from different parts of the world, our businesses are getting their income. And we want to be diversified. We don't want to be concentrated in any one place. Over time, I think great businesses will do well, and I think currency hedging might be something you need to do if you're a short-term investor, or if you've got leverage, but we're neither. And so our view is it's really just a waste of money, really, to hedge if you don't have a reason beyond just the volatility. I think if you're a long-term investor, volatility is your friend.
I think there's another thing that you've got to remember when hedging a stock. Europe has just been talking about how, I think Porsche was mentioning how they're becoming less competitive because of the fall in the dollar. So the dollar falls, the value of Porsche goes up in dollar terms, but they make less dollars in revenue from America, and at the same time they become less competitive. So there are so many dynamics that happen because of this. Just trying to hedge that nominal amount of the market cap or your shareholding is only going to capture a small fraction of the risk. So it seems to me to be a very impractical thing to do.
I'm going to ask this question anyway, but I think you've already answered it. But we'll just go through it because it has been posed by one of our clients. So would diversifying investments into safe haven currencies offer a natural hedge? And are there any plans to implement such hedging strategies?
I mean, I guess the second part we've answered, no, we're not planning to hedge currency. And we're diversified. You've seen from the revenue chart that our businesses are getting revenues from all over the place. So we're very comfortable at the portfolio level about our economic risk exposure that comes from different parts of the world. Then there have been times where the euro was at high as 140, and our European and as it went from 140 to 1, our European stocks and businesses still did well, and vice versa. So I think hedging might matter if you've got a 12-month view, but if you're in it for 5 or 10 years or 20 years, I think it's probably a waste of time and money.
Thank you very much. Aubrey, did you have?
I mean, look, we've got 9% in Swiss franc effectively through our holdings in Nestle and Richemont. We've got London property. We are actually in many safe havens already, as you've seen from our portfolio. So I think that is our hedge.
Super. Thank you very much for that. Okay, moving on to the next section, which is investment strategy, geographical focus and flexibility. So a couple of questions here. So given the resilience of certain economies like China, what is Mayar's perspective on launching new geographically focused funds, e.g. a China fund?
Well, I would question the premise of the question that China has been economically resilient. I think it's all right. It's barely hanging on, but joking aside, I think we've got no interest at the moment in investing directly in China, let alone launching a China fund. We think it falls into the bucket of too hard from a governance point of view and rule of law and stuff like that. And some people can do it. If I lived in China on the ground, I think I might be able to do it. But from where we are, I think the risk reward just doesn't look attractive to me. Aubrey?
I mean, never say never, but I'm sure that there could come up, one company could come up where we go, oh, you know what, we can get our hands around this. Yeah. Actually, BYD.
Yeah.
I could conceivably see that. Not
very true. Very
not
true.
in the near future, but
I've been known to change my opinion a lot.
Well, when you're understanding the facts change, you should.
Absolutely.
But yeah, who knows? But
also, if the person who asked the question wants to give us $500 million to launch a China fund, we'll definitely change our mind.
As well.
Hopefully that person will get in touch with me, and I'll be delighted to help.
Yeah, I'll buy the first ticket to China.
Yeah. So bearing in mind that question, just really wanted to dig a little bit further. A particular question came in on offering clients more flexibility in choosing regional allocation of their investments, e.g. North America, Europe or Asia. Has there ever been any thoughts along those lines for Mayar?
Well, it's impossible to do in the fund, or near impossible to do in the fund for practical reasons. So we can't do it in the fund. In theory, we could do it in separately managed accounts. I think usually we're trying to allocate clients' assets to where we think there is the best risk reward. But I mean, we're talking to someone now who wants us to run an ex-US strategy for them. So everything in the world minus US. So we're open to it in some cases. And as we get bigger, it becomes easier for us to offer more flexibility. I think in the past, we only did the fund. That made it near impossible. And now we have a much bigger separately managed account business, gives us more flexibility. And in the future, we'll have more flexibility. So yeah.
Super. Thank you very much, Aziz, for that. I'm moving on now to sustainability, ESG, and the impact on returns. So how does incorporating a sustainability emphasis within the portfolio affect the investment returns over time? And would you consider this to be a potential source of alpha, or could it be a detractor for performance?
I think it's a very good question. I know people in the kind of ESG space for the past several years have been trying to argue that ESG stocks do better than average. I personally don't buy it. I've never bought that premise. I think in cases where the numbers have either been fudged to show it or show it, it's merely because there's just increased demand for certain for ESG stocks, or there was some increased demand for a period over others. Economically, I see no reason why something like that would do better. I think there are two reasons why we invest responsibly. I think the number one reason is that we just think there are enough ways to make money responsibly that we don't want to live our lives doing things that we don't believe in. And I think there's an inherent link when we talk about kind of Mayar's business owner mentality. If you own a business, if you own the business in full, you'd run it in a way where effectively it will fit with your ethical values. So I think that's the main and most important reason. Kind of looking back when one is 94 years old, just picking a number, you want to have lived by values and made money in a way that you're comfortable with. To me, that's always been the main reason. I think there's a second argument that is harder to prove, I think, though I certainly think there is an element to it, in that there is an element of reduced risk in some cases by owning businesses with good governance, a good environmental track record, and good social values. In that with each one of these, I think with environmental and social, if you have a bad environmental track record and you've got a bad social behavior, you're always running the risk of society coming back later and saying, no, you're not allowed to do that, and punishing you. And we've seen that time and time again. There's obviously an element of some of the demand these days. Customers prefer customers with good values, but I think there is a bigger risk of, if you dumped chemicals in the river for a while, there are many times in the past where it was okay, and then governments came back when society changed its values and said, actually, no, that dumping that we allowed you to do, you're not allowed to do, and actually you have to go back and clean it up. So I think there's an element of de-risking a bit in having these. And I think on the governance side, I think it's a no-brainer. I think bad governance leads to much higher risk as a minority shareholder in a business. So to me, those are the two reasons, but I don't see how it adds or subtracts from return per se. I think makes you feel better about yourself later in life, and to some degree reduces the risk. Aubrey?
Yeah, I mean, look, if you have a universe of 100 stocks and you say you can't invest in 20 of them for ESG reasons, that's probably going to affect your return.
That's true.
But we have a universe of 10,000 stocks. Yeah. If you reduce it by 2,000, we've still got 8,000. There are still so many stocks to choose from that it does the incremental, lack of choice, as it were, just is not going to have that much of an impact. Yeah. But I wholeheartedly subscribe to your view that you just espoused there, that something that is bad ESG wise is going to have increased risk. I think anything you do which a lot of people might perceive to be immoral is going to be subject to regulations. And I think about alcohol. I remember when I was younger, not that I ever drank them, they looked horrible, Alka-Pops. That was something that was regulated away. If you built your business around something that was unethical, as in effectively selling alcohol to children, guess what? Someone comes in and regulates it away. Tobacco, that was regulated. Now, actually, it turns out that it worked really well for the tobacco companies, but that's a sort of,
doesn't always work that way.
Yeah, in hindsight, it did. But if you ask me, would I like any of my businesses to be massively regulated because they had done what the tobacco companies had done? I'd say no. I think that might harm returns. So yeah, I think it's always going to carry with it, that extra bit of risk. Actually, you look at Facebook now. People are talking about social media being the next smoking. And the talk of regulation happening there. That's that has to be a significant risk to them. So I think we miss a lot of risks by that. And again, as you're saying, if your environmental stats are getting worse, if you're starting to pollute more and more, apart from anything, it means you're probably becoming less efficient. Yeah. And that's just a bad thing anyhow. Or if your health and safety record is getting worse, there is just something fundamentally wrong with your operations. So people who are actually able to improve on these things, are probably actually going to be better business in general.
I couldn't agree more with you there, to be honest with you. Thank you very much for that insight, gentlemen. I'm moving on to performance, market outlook, and investment patience. So a couple of questions here. I'll break them down because it's kind of a flip of two sides. The first question is, can you explain the reasons for the current lag in returns compared with the benchmark?
Sure. So I think, as I mentioned earlier, 2023, 2024 were very disappointing years for us, and we have acknowledged that in the past, and we apologized then, and we continue to apologize for disappointing people. Now, we don't like to disappoint people, but we think sometimes it is a potential outcome of a decision that we're willing to live with. And we have to think about these things separately. We, in 2023, 2024, found that a lot of equities, especially the Magnificent, what then became known as the Magnificent Seven, were just extremely overvalued. And you've seen them go up in price a lot, and we've missed out on that. And that has really hurt our relative performance. And we stuck to our knitting, we maintained our conservatism, and we were hoping for things and for the market to wise up earlier, and it hasn't. But we saw in 2025 how quickly things can turn, especially in that area of the market, once the risk-on mentality starts to wobble. And we think this is just the beginning of what's to come. And we've seen how well our portfolio has done in that kind of environment. And at some point in April, when the market was down double digits, we were actually up. So we know that our portfolio has been positioned for a while in this matter. It's not easy having resisting FOMO, right? It's always been and it will always be the challenge for investing, but it's the right thing to do. and it's something that we've always prided ourselves in doing. You know, I was showing Aubrey earlier my suit at the inside. Instead of my name, it says actually no FOMO. And I guess I have a hat here. I'll put it on. I'm talking about no FOMO. But the truth is, you have to have no FOMO. It's the easiest thing to do to fall for these things. And investors do every now and then. But once things turn, it becomes extremely, extremely painful. And we will never take risk with our investors' hard-earned savings, hoping to make a little bit of money over 1 year or two while exposing them to a permanent loss of capital. And we believed at the time and continue to believe that buying things at such high valuations is a huge risk that we're not willing to take. We think it will turn. We're confident that our portfolio is going to perform well in that environment. Is it going to happen next month or this year? I don't know, but I'm very confident that what we saw is a harbinger of what's to come. Aubrey?
Yeah, I mean, look, I have the same confidence as you do, but if it doesn't turn out that way, I think the thing is we're still going to do the safe thing. We're still going to take the sensible approach. You know, maybe there are some people out there who are massively overweight US, overweight Tesla, Bitcoin, and you know, to me, that's the sort of person who's walking around with a lit cigarette and match through a firework factory. You know, they might get through it alive, and great on them if they do. And, you know, I hope they do in many ways, but it's not sensible.
No.
And I don't think owning a portfolio like that is sensible in this market. But you know, I don't think taking risk in excessive risk in names like Tesla is sensible. But sometimes doing the sensible thing does not pay off as well. And that's just something that we have to live with, and we have to have the patience to go, well, you know, in the long run, it really does work because, you know, we don't sort of become a firework factory that explodes.
Well, I think if you do stupid things time and time again, eventually you don't live to tell the story. And I think when we started out, we said our goal is to generate attractive risk-adjusted returns. And there will be times in the market cycle where generating high returns comes with unacceptable risks. And in those scenarios, our job is to protect our downside, prepare, but not do anything silly.
So do you think now then, bearing in mind our consistent messaging to our clients over this last few years and our process, and we stuck to our knitting, do you think that our process, do you think everything is now being validated and that we're in a good place?
Ask us that in a year's time.
No, I think what happened here today, and especially what happened in April, just shows people the risk reward that's embedded in the market and the risk reward that's embedded in our portfolio. And it shows you how positioned we are. And I don't think this volatility that we saw in April is the end of it. I mean, I don't know what's going to happen. I can't tell you numbers, but I think we are in an environment where there's going to be increased volatility and increased risk. And in that environment, I think our strategy will shine. I think the returns that were generated in 2023, 2024 were generated with unacceptable risks. And I think we have different kinds of risks today, but I think it's an environment where what we do is going to work better. And as Aubrey said, our goal in the end isn't to predict what the market or what everyone else is doing. Our goal is to make sensible decisions and generate good returns without taking silly risks for our clients, knowing that over time that should lead to outperformance, but over any shorter period of time it may not. And that is just basically what we think we should be doing.
Super. Thank you very much. Very compelling. Right, we've had a stock specific, and I know you both like to talk about stocks. So this is on the Johnson Service Group. So can you provide a more in-depth explanation of your investment thesis on that company, its rationale partly based on the comparison to businesses like Cintas, which trade at significantly higher multiples, and a belief that the Johnson Services Group possesses a similar entrenched advantages that could lead to a higher valuation?
Well, I'm always reluctant to talk about any individual name. I find that if we start sharing our thesis on why we own this or own that, eventually gets to our head, and like I said, I like to change my mind. So I want to maintain the intellectual flexibility to be able to wake up tomorrow and change my mind on anything that we own. That being said, we do talk a little bit about the businesses when we buy them, and we've talked about Johnson Services Group in the last quarterly letter. I've got nothing more to add to what we wrote, so I encourage the person who asked it, just in the interest of time, to go and read what we said about it then.
Oh, I'll give them a little bit. I am fairly certain that this is going to be one of the candidates who applied for the research position job.
Because we asked
because
them.
This was the case study.
Right.
I mean, just to touch on the recruitment process, we had such a huge number of applicants. It was actually quite humbling that so many people wanted to, come and work with us. And we had so many great, and we had so many great candidates, and quite a lot did the case study, and we had some great responses. But what really sort of made the great response, and one of the things that we were looking for, was real analysis into the quality of the business. And for us, one of the really great things about this business is something called service density. So what that is, quick little backstory on Johnson Services. They do linen and flatware. So they will go to hotels and bars and restaurants, and they will wash your napkins, tablecloths, bed sheets. And you probably see the lorries
Cutting edge technology stuff.
Absolutely. Yeah. Now, imagine if Mayar Ventures had a lot of money and we decided to set up. We get our laundry, we buy some washing machines, and then we sort of try and get a few clients. But the thing is, we're going to really struggle because we've only got one client, or maybe two. But the more clients you get, the cheaper it becomes, because you pay the delivery driver the same amount whether he does 10 or one client. And once you start factoring in these, this service to ad density dynamic, all of a sudden you realize how difficult a business this is to replicate and how entrenched a position gets. And this is sort of one of the reasons that Cintas, that you mentioned, was able to command such high returns on capital and able to compound for so long. And so the point of Cintas is not so much that we think it can achieve their multiples. Maybe it can when they get bigger, but it's more that they can achieve the same level of compounding, or maybe not as great, because the UK is not necessarily as dynamic a market as the US was over the last 20 years. But it doesn't have to. I mean, Cintas is up tens of thousands of percent over the last 20 years, because it's one of these boring businesses that if you can compound at 20% a year for 20 years,
it's magic. It's just
it really is. And and we think Johnson Services can do something similar, but if maybe not quite as good, but something that we'd be very happy with.
Super. Well, I hope that was helpful for the candidate, whoever it was who posed that question. Final question. So this is a great one, my favourite. Warren Buffett. With possibly the best value investor, Warren Buffett, retiring at the end of the year, do you think it is possible to replicate his returns for someone starting now?
I mean, the short answer is no, I don't. I don't think it's possible. I think, and for many reasons. I do think that he is unique in terms of talent. But I also think his track record is unique in terms of the time when he started, the time he invested, the competition he had or lack thereof for investments over that period. And I think there is something to that. I think there's just a lot more competition today. I don't know if anyone is as smart as Warren in this particular kind of talent area. I know I'm not. And I think the environment from where he started investing and throughout has just changed. I doubt that we'll see another Warren Buffett as a stock picker. But also I think part of the greatness of his track record comes from identifying several trends about investing. And some people talked about value investing 1.0 and value investing 2.0, and people talk about value investing 3.0 today. He was years and years ahead of everyone else in that. And I think just the industry has gotten a lot more sophisticated. There's a lot more firepower that has gone into it. There's a lot more technology that went into it. It's just a lot more competitive, I think. And he acknowledges that. I mean, him and Charlie talked about how in the past it was really like shooting fish in a barrel, and it's just gotten a lot harder for people today to do that. There's just a lot more competition in the stock market. Now, every now and then, I think the market can get silly cheap, and it does give you these opportunities to make great returns. But I think overall, the opportunity set is just not as easy as it used to be, I think. And I think that's changed. But again, I also think he is unique as an individual in terms of talent, in terms of intellectual ability, and especially the combination of Warren and Charlie. I don't think there ever was and ever will be anything like them. So that's kind of my take on it.
Well, I'm not quite so... look, they're still fantastic investors. Do nothing I say is going to detract from that. They are super investors. The question is, are they absolutely exceptional, or are they just sort of exceptional? I would say, look, there are a lot of investors who are fantastic. There are a lot of fantastic investors out there who have compounded at, let's say, 20% returns for a period of time. They haven't done it for 60 years. Probably because they're sane. Because Warren, but I'm not just saying they're human. The thing that is truly exceptional about Warren Buffett is that he's been able to do it for 60 years. If you took any of the great super investors and gave them 60 years to do it, they would achieve similar-ish results. It's because the power of compounding is such that your first 10 years, your first 20 years, that you don't see, I mean, it's huge in 10, 20 years, but when you go to 40 years, it's just absolutely extraordinary. I mean, what was the stat that, 90% of Warren Buffett's wealth was created in the last 10, 20 years or something?
This is the way compounding the math works, yeah.
Exactly. It's the thing that's extraordinary is the time he spent doing it. If he didn't spend that much time, he would just be another super investor.
Well, I think the amount of risk taken to achieve it has been below what others.
Yes. Again, there are so many people that we could go through and say, and also that he was able to do it so liquid. I mean, James Simons, he also must be one of the great super investors, but his strategy was never so liquid that it could scale in the same way. But his returns far surpassed Warren Buffett.
Definitely.
So, when we talk about great and exceptional, there are so many different forms of great and exceptional. I just think there are so many great managers out there. I'm not going to just sort of put Warren Buffett on a pedestal and go, this is, the guy to follow. There are just all of them, and I want to try and take the best bits from all of them, including James Simons. Not that I'm remotely intelligent enough to understand, anything that Renaissance do. Well, maybe a little bit. But.
I find what he just said blasphemous. So I'm not. I hope that God forgives me.
So it's like I've got a super fan and a fan by the side of me, right? I've got it. Gentlemen, we have come to the end of the questions, which leads me on to say thank you very much for your contribution, your insight, your wisdom, your opportunism, and the fact that we're so excited about the portfolio going forward despite the volatility backdrop. And that leads me on to you, to the audience.
I have something to add.
Please.
It's become very, very popular to say things in the last 5 minutes of a meeting these days. I am not leaving. But I wanted to thank everyone for joining us today. Before I'll hand it back to you. I want to thank everyone for joining us today. I also want to say go Arsenal. Back to you.
Right, on that note, I too would like to thank everybody for joining us today. I would also like to thank our clients for their continued support and contribution to the Mayar Responsible Global Equity Fund. As ever, if there are any questions that come up after this session, please do message the investor relations team and we'll be happy to respond to you. But other than that, I would like to close the 2025 annual general meeting to a close and wish you a good day wherever you are. Thank you.